It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Here's a bit of a disturbing report. Australia is wasting more than $1 billion every year building off-street car parks that end up unused and unwanted. The report recommends scrapping rules that force developers to include a minimum number of car park spaces when building houses. The Wasted Space report found that upwards of 40% of car parks were left empty every night in apartments in Sydney, Melbourne and Brisbane, and there are now more car spaces in apartments in Sydney and Melbourne than cars. How crazy is this? The report found these parking minimums increase construction costs by $70,000 for a two-bedroom Sydney apartment. Parking minimums add $62,000 to a price tag of a two-bedroom Melbourne apartment, $113,000 to a one-bedder in Brisbane, and $137,000 in Perth and $95,000 in Adelaide.
Look, it's an interesting one, Craig. The challenge is, of course, for most buyers, they've still got the psychology that they need car bays, and even if they won't necessarily use them, there's always that occasion they might. And for rental purposes, people think tenants will need a car base. Certainly, I think that the council should not impose minimum car bays, but I think you'll find still many buyers will still want to have those car bays for the just in case.
Now, let's have a look at the Perth property market. We have talked about recently Perth's property market beginning to show signs of this slowdown. And what are buyers in Perth doing since the budget announcement? Well, they seem to be becoming far more cautious, with some agents reporting longer selling times and less aggressive offers, particularly in the middle market suburbs. What are you seeing and observing around where you are?
We certainly have seen a slowdown. There was, Perth's had a very significant growth trajectory over the last 5 years. So it's slowing down off a very high level, but still growing at a fairly solid rate. Clearly, the budget changes are going to have some impact. The investors in established areas are going to have less borrowing capacity. There's obviously, they can't use that negative gearing for cash flow as the proposal stands. It's coming off a high growth base to something more moderate, which is what we needed, but it certainly has no signs yet that we're going backwards. It just seems to be a slower rate of growth.
What about the unit market? What is happening around that space? Because it does remain, and hardly surprising given what we know, very highly competitive. Some units are selling within 7 days, and if you are a first home buyer, you are chasing these lower priced opportunities as they present. But the investors, they are still in there, aren't they? But what do you think likely to happen in that particular market, the unit affordability market?
Well, look, as the house prices move towards that $1 million median, it's priced a lot of young people out to, even on good incomes, it's very hard to borrow to that level to buy a property at that price. We have seen that switch. People go, well, look, if I can't get into a house or even a villa, I'll look for a unit. And so that's why that market has been in strong demand. But what I'm expecting to see now, while there were certainly investors looking at and buying in that space, given the change in negative gearing, we have certainly seen a push towards yield already. Investors are saying, well, look, still want to buy an investment property, but I really want to get something that's got a better yield than maybe a traditional house would. So that's pushing more investors towards a unit type product. And not only that, borrowing capacities come off a bit because they can't use negative gearing in their servicing. I think we're going to still see the lower end of the pricing in the market, particularly in those units. I think that's still going to be pretty strong for a while as we see that change as existing investors switch more from a housing product towards a unit market where there's better yields and there's more affordability for the investor.
Okay, back to this problem of wasting more than $1 billion every year building off-street car parks that end up unused and unwanted. So, what can be done about this problem? Well, they suggest unbundling car parking spaces so that they can be bought or rented separately from a unit. Several councils have decreased their parking minimum requirements over the years, but the report says that they should be abolished altogether. They estimate that this would result in 86,000 fewer car parking spaces being built in the next 5 years. The result, a staggering $5.2 billion of savings. Their model suggests scrapping these laws would result in 140,000 more dwellings being made commercially viable across Sydney and Melbourne alone. Yes, because that's a real problem, isn't it? Because the developers, we're in that space of trying to make the numbers work commercially. So take that component out and they're going to have a much better chance of putting that development forward.
Don't navigate the real estate market alone. Let us help guide you in the world of real estate every day. Make better informed decisions with the latest news and insights.
This is really interesting, Craig, because the evolution of the information coming out, almost the drip feed, plus the sell job that needs to be done by the government. We've just had a slightly different story each day about the effects of the CGT changes on property investors across the country. That CGT rate will change, obviously, from its current concoction of essentially there being a 50% discount rate for people that have held a property for longer than 12 months, whether that's owner-occupier or investor. But in particular, we're worried about the investor side of things here, where the rate of tax will go up as of 1st of July 2027, based on the proposal from the government. And what I'd picked up on here, Craig, is the government started their sell job with the concept that this would make it easier for first home buyers to get into our marketplace, essentially on the concept that investors wouldn't like this CGT proposal, and so they might think about selling their investment properties around the country. And what we're probably concerned about there is, in terms of that concept, is, if anything, the looming higher tax rate might actually make investors sit on their hands and hold the property for longer, and actually have the opposite effect, essentially mean that there's less supply in our marketplace because existing investors retain their investment property and don't release it to the market.
Yeah, this is a double whammy for Perth, because we were in Perth yesterday morning. But I want to drill down on the investors that you're talking about, because it has been a fantastic time for Perth with investors coming from Melbourne, Sydney and Brisbane. That balance of those investors to continue coming into Perth, yes, there have been a number of investors pivoting, moving out of Perth and going into the likes of Melbourne. But how concerning is all of what you're talking about for those investors to keep coming into Perth based on the budget stuff?
Yeah, so Craig, what we're probably concerned about there is just the effect of removing a segment of our market. So the investors essentially exiting potentially the Perth market. Now, just to remind everyone, the stats say that we've had about 24% increase in value over the last 12 months, and on the average or the median house price, which now sits around about $1 million. And if I can drill down into the southeast corridor of Perth, so down into suburbs like Armidale, what we saw is investors from those capital cities up and down the east coast coming into our marketplace. And some of those scenarios would be that they may have purchased through, say, a buyer agent a couple of years ago. They would have paid in the order of $300,000 to $400,000 for a single residential dwelling on a site down there. The value of that type of product now is pretty much doubled. They're at now $600,000, $700,000. And so what we're just trying to think through in terms of scenario testing this is, will those investors exit our market and increase our supply and potentially making that marketplace slightly vulnerable to value correction? Or will they hold knowing that they've made that gain and they don't want to realise capital gains tax? Now, the other thing that's underpinning their investment is the fact that rents are still really healthy in right across Perth, and in particular in those locations. So as an investor, the reason you bought that property is to gain a return, and that return remains healthy and is probably increasing. So we'll wait to see what happens in terms of their investment strategy.
If the present government is attempting to deal with the issue that home buyers are facing getting into the market, this absolutely is not the way for them to do it. You'd like to think that before such big announcements are made, that the government is going to consult with industry, that they're going to do the proper modelling, they're going to work out exactly what the intended and unintended consequences are of proposing such moves.
Yeah, the budget has certainly been a talking point here, and with a lot of commentators, including economists. Getting back to the market, the auction clearance rates around Australia, they are still sitting at relatively soft levels. While Sydney and Melbourne saw a slight improvement last week, the numbers are still well below the boom time levels that we saw in 2021. Brisbane has weakened further, while Adelaide continues outperforming most capital cities. So yes, they're a long way away, those clearance rates, from those boom times in 2021, which was at 80%.
And I think what we're seeing happening here is investors and even home buyers are adopting a wait-and-see attitude. These auction clearance rates dramatically turned when the first whiff of what might be in the budget came out. So that was several weeks ago now. And then on budget night, when the announcements were made, I think everybody just went into silent mode and decided that rather than take any kinds of risk before we know the detail, that they might just wait and see where it all heads. And it's interesting, isn't it, that even though these announcements were made, we don't know the detail. One of the biggest problems that we have in this country today is undersupply, and we also have a market that is so unaffordable in our larger capital cities that even with every measure you can imagine to try to make the road a little easier for first home buyers into the market, we are years and years and years off the market becoming affordable enough for the average income earner to be able to buy into that market. So I guess the biggest issue that I have with this budget is that it proposes to take away aspiration from so many parts of our country. Young people wanting to get ahead, investors wanting to plan for their own retirement and not be a burden on the country. It takes all of that away for a result that can't be confirmed or even modelled correctly, and for a result that's probably not even going to happen.
Yeah, and even though buyer demand has softened, having a look at just where we are at the moment, Australia still has a major housing shortage sitting underneath the market. Migration, how many times have we been talking about that? It remains still strong. And hundreds of thousands of additional people, they will still need somewhere to live over the next few years. Construction activity, yes, it is improving, but supply is still struggling to keep pace with that population growth. And that is why so many economists don't see a property crash unfolding. How can you? Because the migration is out of control as well.
And let's think about where all this leads. So we have people pouring into the country at a rate of knots. We have an undersupply of property almost everywhere in the country. We suddenly have a huge demand on the rentals because people can't even find the property to buy if they could afford it in the first place. We have considerably less landlords who are now unwilling to enter a market that not only has changed, but where we know the changes can happen at any time. So suddenly we have less rentals available as well. What happens next? Rents skyrocket. And then all those people who want to get into the property market, even if prices moderate, they can't afford to save the deposit that they need because all of their money is going to rents. You can see where I'm going with this, can't you? It's just like this vicious cycle, and there's just no way to break that cycle with the current policies that are being proposed. And all I can see happening out of the removal of negative gearing for property investors in established properties is that we're going to see all of those developers now come out of the woodwork selling overpriced properties in far-flung suburbs that have got absolutely nothing going for them in terms of their capacity to grow over time, selling these properties to people who are buying them just for the tax benefits. And those same people are going to end up owning these properties that there's no secondary market for or reduced secondary market because investors aren't going to be buying established properties. So, the whole thing is just so badly thought through. Whether you like it or not, investors are part of the solution. They aren't the problem.
We are your local source for unbiased, expert insights into the world of real estate. We are not a real estate company. Our only objective is to help you better understand the real estate market.
And did mention that some are turning away from residential property investing and looking at the commercial property, which is quite a different thing. You know, there's so many things you have to learn about commercial versus residential, which is pretty straightforward.
Yeah, you're spot on there. I mean, typically, a mum and dad investor, residential makes the most sense. There's less complexity. It's an asset they're usually familiar with, particularly if they own their own property as it stands. So for someone to then pivot and look at commercial, there is a bit more complexity involved. Often, you're purchasing in a different type of entity, whether it's a trust or a company. So it is potentially a pathway forward for some people, although they need to be comfortable that they've done enough research and they understand what they're moving into.
Let us know if this is you, if you have decided to get into the commercial space and pivot. Our email address is myrealestatepodcast@gmail.com. Boy, we would love to hear from you and exactly what you're doing around that space. Now, has the Australian investment property model, do you think, fundamentally changed for average mum and dad investors?
I think what we're going to see is a lot of investors will probably shy away from investing in traditional real estate. And I think maybe they'll look to park their wealth more into their owner-occupied property, right? Where they're not going to be as affected, hopefully, longer term when it comes to capital gains and those impacts. I think my client base already, they're looking at alternative style of investing where maybe, they're accessing their equity and they're investing in shares or ETFs, maybe with their financial planner. Again, these are clients that are in really strong equity positions, but they're just not able to afford that investment property without the negative gearing helping servicing.
We connect you to the best real estate information across Australia. The Real Estate Podcast.